what if the biggest threat to the whole artificial intelligence revolution isn't rogue software or, a lack of microchips, but just a simple lack of concrete copper and physical space?
Right, which sounds so counterintuitive. We uh, we we so often look to tech companies to tell us where the economy is going, but sometimes the most profound warnings come from the businesses managing the literal physical foundations of the world.
Yeah, exactly. And that is exactly our mission for this deep dive today. We're going to look beyond the surface of a standard corporate earnings report to uncover what looks like a fascinating blueprint for the next decade of the global economy.
And we are pulling from a very specific stack of documents for this, right?
We are. So we're looking at documents from April 16th and 17th, 2026. Specifically, this is the Q1 2026 earnings report, the presentation slides, and the earnings call transcript for Cohen and Steers.
Which, if you don't know them, they trade on the New York Stock Exchange under the ticker CNS.
Right, CNS. And they are this massive global investment manager specializing in real assets.
Yeah, so they focus on tangible things: real estate, infrastructure, natural resources. I mean, the literal plumbing that keeps the economy moving.
And just to set the scene for you really quickly, we also pulled some broader market context from MarketDeep to show what the world looked like that spring. And I mean, the market was incredibly volatile.
Extremely. You had, major tech stocks holding relatively steady, but then you look at a traditional energy giant like ExxonMobil, for example, taking a massive 5.19% dip.
Right.
Investors were basically frantically trying to figure out which way the wind was blowing. It was a moment of profound recalibration for, well, anyone managing wealth.
And what caught our eye here wasn't really the profit margins of this specific firm. It was a severe warning buried in their call about a 10-year shift in the global economy.
Yeah, the executives at Cohen and Steers basically lay out how geopolitical shocks and the boom in artificial intelligence are just completely rewriting the rules of investing.
They essentially outline a future where the strategies that worked over the last decade are, almost guaranteed to fail in the next one.
Which is a bold claim.
It is. So, okay, let's unpack this. Because to understand their massive prediction, we actually do need to start with their raw numbers. It's the paradox of their Q1 performance that perfectly sets up this whole narrative.
Right, the financials really show a firm caught right at a historical pivot point.
Exactly. So financially, Cohen Steers had a quarter that was, well, somewhat mixed, but underneath, incredibly strong.
How so?
Well, their revenue actually beat expectations. They brought in $144.26 million, which is an 8.3% growth year over year.
That's solid.
It is.
Yeah.
But their earnings per share, their EPS, it slightly missed the mark. The consensus was 82 cents, and they landed at 79 cents.
Ah, okay. So you have a very healthy top line with revenue growing, but a tiny miss on the bottom line profitability.
Right, exactly. Meanwhile, though, the actual money people are trusting them to invest their assets under management grew significantly. They hit $93.1 billion.
Wow. 93 billion.
Yeah, and they saw nearly $500 million, $497 million to be exact, in net inflows just during the quarter.
So people are actively pouring money in.
They are, and their performance metrics justify it. I mean, they're staggering. 86% of their assets outperformed their benchmarks over the last year.
86%.
Yeah. And 95% of their open-end fund assets are rated 4 or 5 stars by Morningstar.
I mean, those industry-leading metrics tell you their underlying investment strategy is working. Like, people are giving them more money because they're consistently beating the market.
Right, so it's like getting an A on your coursework all semester, but, slightly missing the final exam expectations because the professor suddenly changed the entire curriculum the night before the test.
That is a perfect analogy.
Yeah.
Because the executives on the call highlight exactly when that curriculum changed.
Yeah, they noted the year started out with accelerating fundamentals. Everything was looking great. But then they explicitly state the world changed on February 28th.
Right. And that date marks the geopolitical shock involving the U.S. and Iran.
Yeah.
And looking at this purely through an economic lens, the firm notes that this event immediately paused business activity.
The call transcript actually says the market consensus instantly shifted from optimism about reflationary growth right back to fears of stagflation.
Which is a huge swing. We should probably define those terms for anyone who, isn't staring at financial charts all day.
Yeah, definitely. So reflationary growth is...
Well, reflationary growth is generally the scenario everyone wants after a downturn. It's when the economy is expanding, people are spending, and prices are rising at a healthy, manageable pace.
the good stuff.
The good stuff. Stagflation, on the other hand, is the ugly opposite. It's the worst-case scenario where economic growth just grinds to a halt, it stagnates, but prices keep climbing anyway.
Which is brutal for consumers.
Brutal.
So what's fascinating here is how quickly a geopolitical conflict thousands of miles away forces a real estate and infrastructure portfolio to just recalculate its entire strategy overnight.
Well, markets despise a vacuum of information, right?
Yeah.
A major conflict in the Middle East immediately impacts global shipping routes.
Right.
And when shipping is disrupted, supply chains bottleneck.
Mm.
When supply chains bottleneck, the cost of raw materials spikes.
Which drives up inflation.
Exactly. It drives up inflation across the board. And when inflation spikes, central banks step in and interest rates tend to follow. All of that directly impacts the valuation of the hard assets that Cohen Steers manages.
So the Q1 paradox is essentially them saying, we are performing exceptionally well, but the entire macroeconomic playing field just tilted 15 degrees.
Yeah.
And this sudden shift is what prompts their chief investment officer, John Shea, to make a major declaration. I mean, he makes it very clear they are not treating this February shock as a one-off anomaly.
No, not at all. He treats it as the final confirmation of a structural transition in the global economy that will play out over the next 10 years.
A full 10-year shift.
All right.
And this transition isn't just a list of random topics, it's a domino effect.
Right.
The first domino falling is what they call geopolitical fracturing or, deglobalization. Because for a few decades, we lived in an era of hyper-efficient, friendly global supply chains. Oh, yeah. The entire corporate world optimized for just-in-time delivery. I mean, why stockpile parts in Ohio when you can get them shipped cheaply from overseas exactly when you need them?
Exactly.
It kept costs incredibly low.
But Cohen Steers points out that we've had 4 massive supply shocks for just 6 years.
4.
Yeah. The pandemic, the war in Ukraine, an era of heavy trade tariffs, and now this conflict in the Middle East.
And the realization among corporations and governments now is that efficiency has come at the cost of profound fragility.
Yeah.
The era of relying on distant, unpredictable supply chains is just ending. We are moving toward a massive reindustrialization phase. Countries have to build manufacturing and supply infrastructure closer to home, which requires an astronomical amount of raw materials and labor.
Which naturally brings us to the next massive demand for physical infrastructure.
Yeah.
And wait, let me challenge something here, because this is the part of their thesis that completely flips conventional wisdom.
Okay, go for it. They point to artificial intelligence as a major driver of this new economy. Now, the common narrative is that AI is software, right? It's code that will make workers ultra-productive, automate tedious tasks, and therefore make things cheaper.
Right.
It's supposed to be this deflationary miracle. How is Cohen Steers arguing that AI is actually causing inflation?
It is a brilliant paradox. Because the ultimate output of AI might indeed be deflationary, decades from now. But the physical construction required to reach that point, it is violently inflationary.
Wow, violently inflationary.
Yeah, because AI requires unimaginable amounts of computational capacity. To achieve that, you need massive data centers.
Which aren't just like empty warehouses.
Far from it. They require specialized concrete, advanced cooling systems, and millions of miles of copper wiring.
And power.
Exactly.
Right.
More importantly, data centers require a staggering amount of power. The local electrical grids in many parts of the world simply cannot support the energy demands of the AI revolution.
So building the deflationary software machine requires a highly inflationary physical construction boom.
We basically have to completely upgrade the global power grid. When you combine the reindustrialization from deglobalization with the massive physical footprint required for AI, you create an unprecedented demand for raw materials and labor.
And when demand outstrips supply, you get persistent inflation.
Right.
Which leads directly into their forecast for the next decade, because they are explicitly projecting that U.S. inflation will average 3% annually over the next 10 years.
And that projection is incredibly significant.
Why?
Because the Federal Reserve's stated goal, their absolute holy grail, is 2%. The entire financial system is calibrated around returning to that 2% baseline.
So Cohen Steers is basically telling investors, forget 2%. That world is gone. Get used to 3%.
Exactly.
I want to dig into that because, 1% sounds like a rounding error to most people. Why does that matter so much for the average listener?
That single percentage point completely changes the math of wealth preservation. Let's look at the compounding effect. At 2% inflation, your purchasing power halves in roughly 35 years. You have time to adjust.
Right. 35 years is a long time.
But at 3% inflation, Your purchasing power halves in just 23 years.
Oh,
That extra 1% literally steals a decade of your wealth if your money is just sitting in a savings account or a low-yield bond.
man.
Yeah.
And to combat that kind of inflation, central banks have to keep the cost of borrowing high, right? Which is the final piece of their 10-year transition blueprint, the end of low interest rates.
Yes. We are entering a highly capital-intensive world. Building local supply chains and AI power grids costs hundreds of billions of dollars. When the demand for capital is that high, borrowing costs stay elevated.
The sources mention that credit spreads will stay wider. Can you translate that for us?
Sure, a credit spread is simply the gap in the interest rate between a super safe investment like a U.S. Treasury bond and a riskier investment like a corporate loan. When the economy is uncertain, investors demand a much higher payout, a wider spread to take on the risk of lending to a corporation. Wide spreads mean companies have to pay a premium to borrow money, which cuts into their profit margins.
Got it. So, to summarize, we have a decade defined by fragile global supply chains, an inflationary physical build-out for AI, a baseline of 3% inflation eroding our purchasing power, and high borrowing costs.
That's the landscape.
So what does this all mean for you? Like, if you're a listener with a standard retirement account heavy in tech stocks, how do you navigate this?
Well, Cohen Steers introduces a specific strategy to survive this exact environment. They call it the halo trade.
HALO. HALO. And that stands for heavy or hard assets, low obsolescence.
Exactly. The idea is that the darlings of the last 10 years, the pure software companies that thrived on 0% interest rates, are going to struggle. The winners of the next cycle will be the foundational elements of the economy: natural resources, traditional energy, infrastructure, and the underlying real estate.
It's like everyone is fighting over who gets to design and sell the most advanced electric vehicles, completely ignoring the fact that none of those cars will run unless someone physically owns the copper wiring connecting the charging station to the grid.
Right.
Cohen Steers isn't trying to pick the winning car, they're just buying the copper and the real estate the charger sits on.
And if we connect this to the bigger picture, the halo strategy is about finding assets that automatically adjust to inflation. Real estate is a perfect example because a landlord can raise rents as the cost of living goes up, effectively hedging against that 3% inflation target.
Right, and the documents provide a really stark comparison between real estate investment trusts, or REITs, and the broader S&P 500 to show how this rotation is already happening.
Yeah, the numbers are telling.
Over the last few years, REIT earnings grew at a sluggish 2 to 4%. Meanwhile, the S&P 500 was growing at 10 to 12%.
Real estate lagged significantly because there was excess supply in the market, particularly in commercial office space post-pandemic, and rising interest rates made mortgages highly expensive.
But Cohen Steers points out that the script is flipping. The S&P 500 is currently very expensive to buy into, and those top tech companies are facing massive capital expenses to build those AI data centers we talked about.
Yes.
Meanwhile, the real estate market has digested its excess supply. Because borrowing costs are high, no one is building new properties, which makes existing properties much more valuable.
The fundamentals have completely inflected. They're projecting REIT earnings to accelerate to 5 or 6% this year and 7 to 8% next year.
Wow.
It is a textbook market rotation back to hard assets.
Okay, so having established why hard assets are the future, the final major theme in this earnings call is exactly how investors are moving their money. And there's a massive exodus happening away from an asset class called private credit. Wait, but hasn't private credit been the absolute darling of Wall Street for the last 5 years? I feel like every wealth manager couldn't stop talking about it. Why the sudden panic over liquidity now?
Well, it was the darling when markets were stable and predictable.
Ah.
Private credit is essentially wealthy investors or funds lending money directly to companies, completely bypassing traditional banks. It offered fantastic yields during the low interest rate era. But it comes with a severe catch. It is highly illiquid, and it lacks transparency.
Illiquid meaning you can't just log into an app and sell your position on a Tuesday afternoon if you need the cash.
Exactly. Your money is locked up for years. Furthermore, because these loans are private, they aren't marked to market every day like a public stock.
Yeah.
You don't actually know the true financial health of the underlying companies you lent money to until something breaks.
It's a black box.
A total black box.
So when a geopolitical shock happens, like the one in February that instantly paused business activity, investors suddenly realize their money is trapped in that black box.
In a highly uncertain world, the cost of illiquidity becomes terrifying. Investors are aggressively demanding liquidity frameworks. They want higher yields, but they absolutely must know they can access their capital if the global economy takes a sudden downturn.
And Cohen Steers is perfectly positioned to capture the billions of dollars fleeing private credit. They are offering transparent, easily tradable structures. Look at their active ETFs.
Oh, yeah.
They now manage $675 million in these funds, and they saw $224 million in net flows this quarter alone.
Just massive inflows.
The demand for liquidity is so high, they're actually converting their Future of Energy fund into an ETF mid-year just to give investors an easier way to trade it.
It is a profound structural adaptation to investor psychology. They are providing the hard assets necessary to survive 3% inflation, but they're packaging them in vehicles that offer daily transparency.
They also highlighted the incredible success of a specific fund, their non-traded income opportunities REIT. The details on this are fascinating because it shows exactly what kind of physical assets are winning right now. So it holds 11 properties totaling $650 million. They aren't mysterious tech hubs or speculative high-rises. The fund focuses specifically on open-air shopping centers.
It sounds incredibly mundane compared to AI algorithms.
It does. I mean, a strip mall, basically. But look at the performance. These shopping centers boast a 97% occupancy rate.
Which is practically full.
Yeah. And because the spaces are almost entirely full, the landlords have immense pricing power to raise rents. This specific vehicle has generated a 10.6% annualized return since its inception.
10.6%.
Yeah, it is absolutely crushing the 4.3% average return of its peers.
It highlights the ultimate irony of the current market shift. Investors are pulling their wealth out of complex, opaque private credit loans that require a PhD to understand and moving it into an open-air shopping center where they can literally drive to the parking lot, see the foot traffic, and buy a coffee.
Yeah.
It is a massive flight to tangibility.
Tangibility and safety. The firm also mentions their preferred securities strategy as a way to capture the money leaving private credit. They are offering near 6% yields with short 2.5-year durations and investment-grade BBB credit quality.
We should decode those metrics because they perfectly illustrate the sweet spot investors looking for right now.
Okay, let's do it.
So a 2.5-year duration means the bond matures relatively quickly. In an environment where interest rates might stay high or fluctuate wildly, a short duration means your money isn't locked in for a decade. You are much less sensitive to sudden rate changes.
Right. And what about the BBB credit quality?
BBB is technically the lowest possible rung of investment-grade debt. If you go one step lower, you fall into junk bond territory, which carries a high risk of default.
Okay.
So BBB is the absolute sweet spot. It provides a much higher yield than the super safe government bond, but it avoids the reckless risk of junk debt or opaque private credit.
So you give up a tiny bit of headline yield compared to private credit, but you gain complete transparency and a structural guarantee of quality.
It's the financial equivalent of keeping your emergency supplies in a well-lit pantry instead of a locked vault you lost the combination to.
I love that. So if we pull all the threads together from this deep dive, what started as a seemingly standard corporate earnings report, a solid revenue beat, a slight EPS mispeeled back to reveal a pretty sobering reality.
Yeah. Driven by a geopolitical shock that forced a massive market recalibration, Cohen Steers basically laid out a compelling blueprint for the next decade. We're looking at the end of friendly globalization, a stubborn baseline of 3% inflation, higher borrowing costs, and the staggering physical demands of reindustrialization and AI.
And their survival strategy for this new era is the halo trade. Heavy assets, low obsolescence. A massive rotation away from the tech-heavy software darlings of the past decade, and a flight away from the illiquid traps of private credit, right back into the physical, tangible world. Real estate, power grids, and natural resources.
The broader lesson here is that portfolios built for the low-inflation, hyper-globalized world of 2015 are fundamentally misaligned for the realities of 2026.
Which brings us back to where we started, looking at this blueprint for the next decade. And it leaves me with one really provocative thought for you to mull over based on the incredible paradox hidden in these sources. If the artificial intelligence revolution, the technology everyone assumes is a weightless, deflationary software miracle, actually requires an unprecedented, highly inflationary amount of physical infrastructure, concrete, copper, and power just to function.
This raises an important question about who actually profits long term.
Right. Are the true financial winners of the next decade going to be the famous tech giants writing the code and building the software models? Or are the real winners going to be the quiet companies pouring the concrete, laying the high voltage power lines, and owning the dirt underneath the servers? It's something to think about the next time you marvel at a piece of new software. Thank you for joining us on this deep dive, and remember to keep questioning the world of information around you.